In a partnership, it's not just about splitting profits at the end of the day. The division of income is often a reflection of each partner's contribution to the business. And contributions aren't just about effort and time, they're also about how much each partner has invested financially. A common method to acknowledge these financial contributions is to divide income based on interest on capital balances. Simply put, partners who have more money invested in the business get a larger slice of the profits. This is a way to reward those who have put more on the line, financially speaking. Now, let's break down one such method of dividing partnership income. This method involves 3 key steps, each of which serves to ensure that profits are shared fairly, taking into account the myriad ways partners contribute to the firm's success. First up, we have partner salary allowances. This is where partners are compensated for their active role in the partnership, like managing day-to-day operations or bringing in new clients. It's a predetermined amount that reflects the value of each partner's non-financial contributions. Next, we consider interest on capital investments. Each partner receives interest on their initial and subsequent financial investments in the partnership. This interest is calculated before the rest of the profits are divided, which incentivizes partners to invest more into the business. Finally, any remaining income is split equally. This ensures that every partner benefits from the collective success of the partnership, promoting a sense of unity and shared purpose. Let's dissect an example to understand how a partnership agreement can dictate the division of profits. We'll be looking at the agreement for the fictional partnership of Stone and Mills. Now, let's look at the specifics of this particular agreement. First on the agenda is the monthly salary allowance. Jennifer Stone receives a monthly salary of $5,000, while Crystal Mills receives $4,000. This salary is a recognition of their efforts and is allocated before any other profit division. Next, we have interest on capital investments. At the beginning of the year, Jennifer and Crystal had capital balances of $160,000 and $120,000, respectively. A 12% annual interest is allocated to each based on these amounts, rewarding their financial contributions to the firm. Finally, we have the division of the remaining income. Any income left after salary and interest allocations is divided equally between Jennifer and Crystal. This encourages a sense of fairness and collective success. Let's take a close look at how Stone and Mills, a partnership with a $150,000 net income for the year, approach the division of their hard-earned profits. Here we see the financial report card of the business. It shows us that after raking in $650,000 in revenues and subtracting $500,000 in expenses, Stone and Mills are left with a net income of $150,000. The division of this income is a multi-step process. First, we account for the annual salary allowances. Jennifer Stone receives $60,000, and Crystal Mills gets $48,000. This reflects their agreed compensation for the roles they play in the partnership. Next, we add the interest allowance, which is based on a 12% return on their initial capital investments. For Jennifer's $160,000 investment, that's $19,200, and for Crystal's $120,000, it's $14,400. This interest rewards them for the capital they've invested in the firm. After these allocations, we have a small portion of the net income left, $8,400 to be precise, which is then shared equally between Jennifer and Crystal, giving them an additional $4,200 each. The bottom line? Jennifer Stone's net income totals $83,400, and Crystal Mills totals $66,600. Together, they've skillfully turned their partnership agreement into a tangible financial reward for their efforts and investment. This detailed division exemplifies the importance of a well-structured partnership agreement. It ensures transparency and fairness in the way profits are shared, taking into account not just the work put in but also the capital risked by each partner. Let's look at a partnership's closing entry. As our example, we have the partnership of Stone and Mills. At the end of the fiscal year, they need to close their books. Here's how it's done. Jennifer Stone's capital account is credited with $83,400, while Crystal Mills is credited with $66,600. These credits represent their shares of the net income, effectively transferring the partnership's earnings to the partners themselves. Now, let's say Stone and Mills decided to form an LLC instead of a partnership. How would the closing entry differ? you'll notice that the structure of the entry is quite similar. Revenues and expenses remain the same. However, instead of capital accounts, we now have member equity accounts for Jennifer and Crystal. This reflects the terminology used in an LLC, but the essence of the transaction is the same. Therefore, whether you're dealing with a partnership or an LLC, the fundamental principles of accounting remain constant. It's the formality and the legal structure that dictate the terminology used in the books. The closing process is a critical step in wrapping up a period's financial activities. It ensures that the profits made by the business are properly allocated to those who have invested their time, money, and effort into the company's success. Today, we've seen how partnerships manage division of income and the importance of a solid agreement. It's a delicate balance between the letter of the law and the spirit of partnership.